Hey guys, thanks for joining me today. If you would, like and subscribe, and let's get into the $10,000 portfolio. We are going to cover the weeklies in this video, and that starts with REC shares. Let's go to the portfolio. And as you can see, it's up $2,700 and change. And these started in March, early, I think the second or third of March of 2026. So for a frame of reference, that's how long these have been going. If you're new, hey, go ahead and subscribe while you're here. Also, tell me your favorite. It doesn't have to be a weekly dividend, but your favorite dividend vehicle. I'd appreciate that. Leave that in the comments and like and subscribe. Roundhill's had a nice return so far. It's up 7% overall, $11,000 up. YieldMax Group 1 isn't profitable, which is good. YieldMax Group 2 is not. It's down $20,000 for the portfolio overall. Defiance is up $4,300, and Granite shares really sucks completely, and it's down $32,000. So why have these done so well recently? A lot of the recent returns have been because of the instability in the stock market. Writing calls, the higher the volatility, the higher premium you can get for your calls. So it's more profitable for the covered calls. So let's go ahead and look at the individual portfolios and see who's the winner and loser in each group. CWI, and a lot of this is share price. It's 1079 average, and it's up to 1555. So this one's been climbing the last couple of months during the unsettled times we're in. Let's see, MSII, which is the Mr. option. It's gone from 652 to 831. Why is that so low? Let's go ahead and take a look at why that one is. So let's go to MS, if I could type, MSII. Alrighty, Mr. Growth and Income ETF. Let's take a 6 month. Okay, so this one had a lot of NAV erosion till the beginning of the year. Here's where we started at around March. And as you can see, it's had a nice little uptick. Let's zoom in on the month. That shows it a little stronger. So a lot of this has been the last month. Let's do all time, see where it started. Looks like it started at a $25 one. Some of these started at 50, some of them started at 100. So it's nice to go back and peek at where they started. And as you can see, it's only going back to 2025. So this is a fairly new fund. A lot of the weeklies are new. A lot of the YieldMax were monthlies for the last couple of years, and then they said they did it because people wanted weeklies. I kind of like the monthly because the weeklies are too hard to get a good read on. I like the monthly because it gives you a 4-week average for stability. But overall, you can see that the NAV erosion is really eating this up, and it's just the last little bit that these have recovered their price. And I'm going to guess, I haven't looked forward too much, but I'm going to guess a lot of these are going to share that. So let's see who's the Roundhill winner. The ARM. So why is it? It paid 59-cent dividend. It's a 63% annual dividend return. Historic yield is higher than the 5-month average, so it's actually ticked up. And it's probably had some Midland. Yeah, see. Here's back before the end of last year when the stock price was falling. It was down to 15 cents. And as you can see, it kind of leveled out. And now it started ticking up in February. Look at that. It jumped to 41. You had that big 26 cent. And then you had a couple of 14s and a 22. And the pullbacks have been smaller. So your increases are beating your pullbacks. So you're up overall. And we're back up to 59 cents. From 36 and 44.51. So we'll take a peek at that next week, see if it keeps being the runaway winner. Who's some of the other ones? Let's go. What's a good return? 60% return on this one. So paid 38 cents a share. And the dividends, I wish they were not this far down, 30, 20, 30. So this one is actually more stable as far as dividend payment. So that's something else you could consider. Do you want something that's just all over the place, or are you looking for a steady payer? Because that's something you could start narrowing these down by. If you have a comment on that, let me know below. YieldMax, let's see the portfolio. Okay, this one's not up as much, so we'll probably get a bigger selection. A lot of winners, but smaller winners. Okay, that's fine. Looks like Chippy went from 55.51 to 69.81. So there's its increases there. 38.12 for GPTY up to 43. So this has had some good NAV increases. QDTY. And the internet's lagging. Let's see. 22. 32% yield. That's 32. So 32 is a good yield. I mean, let's not pretend it's not. If you can get 32 cents or a 32% yield overall, you're doing good. The price increases in dividends have not been great. They've been +2, -5, -4. So we've had a couple detractions. So it went from 30 down to 22. It was up at 34 here. And if you go further back, it's about the same. It seems to bounce between the 30s and the low 20s. And that's QDTY. That's the NASDAQ 100 0 DTE covered call strategy. Oh, that's the 0 DTE options. Okay, I know what that is. All right, so that's that. I want to show you something else. This is for all dividend vehicles. And if you look at them over time, that's where dividends shine. So if you go down here to, holdings. And pick one. We'll just randomly pick one. Go to holdings. There we go. Got to get the right screen. This is a graph of what you'll see. This is normal for most dividend vehicles overall. And what you get is boring the first 10 years. You see these small upticks. You can almost, you probably on your, if you're watching this on a phone, you probably can't even see that there's an uptick right there. But about 10 years is where things start to change. This is where the growth really happens, is from years 10 and on. And if this is at the 7-year or 10-year to double, then every year, imagine what this graph will look like in 30 years. But as this one we picked, in 20 years, it's going to have a almost $3.4 million value. You've received $3,200,000 of that is going to be received in dividends. So there's no stock appreciation cost. And your annual dividend will be $1.2 million. So if these weeklies can even just hold serve for 20 years, if you spent $10,000 now, you'd be a millionaire at the end. But will they hold serve? They didn't when they were monthlies, so I'm not sure what they'll do as weeklies. If you remember and go back at the beginning of my channel, I was following the Yeildmax when they were monthly payers. And a lot of them started having NAV erosion problems because they had so many shares outstanding. They were paying dividends, and then they'd have to sell their holdings to pay the dividends, and then they ended up doing reverse splits. I think it was Misty did like a 10-to-1. So if you had done Misty, if you had followed our portfolio, we had almost doubled our holdings, and then it went from like 200 shares down to 20 shares. So you can't trust these long term, but it's a good thing to know going forward. We'll go YieldMax Group 2. If the computer lets me. This one was down 20,000, so this has really lost a lot of money. Why have they lost so much? One, this is the largest portfolio holding. There's the largest number in there. And as you can see, even though the largest lost is 3,600, there are lots and lots of losses. See, almost the entire group is losing, even though you had 5,000, 3,000, and then there's a couple ones and then nothing. Well, this is another AMD that went from 30.69 to 45.61. So that underlying share price is where all these profits are coming from. Over time, you'll continue to get more and more shares, and then the dividends will add more and more. Let's get through these. Defiance, this one's about break even, up 4,000. You got oil, and you got the NASDAQ, a lot of NASDAQ. So these are not individuals, these are group. So that's another thing. You add a little diversity. A lot of the Yeildmax and some of them are individual stocks, so they're going to really reflect the individual stock price. These group funds are more stable, and these are low priced. As you can see, there's none of them really expensive. This one's at $7.72, went up to $8.93. Why did it do that? Dividend 8 cents. So this one's going to pay 56%. I wish paid a little more, but 8 cents is one thing. I mean, don't forget, you're talking a $8, a $9 stock, and you're going to get an annual dividend of $4.33, which is a little over half the price. And then you're going to go down, and you're going to see that it's paid 5, 6, 7, 8 cents. So this one is stable. It's a good stable return. You could pretty much count on it for now. Like I said, we got a stock market thing going on with the war, but it's not bad. And then I would stay away from Granite shares. This is the one that just sucks. 32,000 down. I don't know what it is that they can't do anything. I mean, some of them, look at that. They have the same stocks. Amazon, Bitcoin, QQQ, Riot, SMCI. They're using the same stocks as the other holdings, but they just can't make money. Let's see, their worst is 807 down to 620. These are all share price losses all the way across. Because if you look, the market cap, a lot of these are still over 10. Well, only half of them are over 10,000. So these just suck. Let's be honest. They're not doing good, and unless they change their structure of how they do it, those I would stay away from. Now, you'll notice I'm not recommending you buy anything because I don't give stock advice. I'm giving you information. But if I see something that's bad, I'll tell you my opinion. It's bad. I just don't want to give you information that I say is good and then you get hurt by it. So I give you information. You can take it with other sources and your professional advisor if you have one, and then you can make a long-term plan. But these are fun because I like doing these dividend what-if scenarios. And as you can see, over short periods, they follow the stock market, but over the long haul, because let's take one of these even losers and see where we're gonna be. We'll pick that one, and we'll go to holdings. And as you can see, even though it says it's quote-unquote losing money, that's also dollar cost averaging because it's reinvesting the dividends. You're still going to have $2.8 million in 20 years. So let's not pretend that there's not something there. But like I said, as long as they're losing that much money and there's these other options that are not, I would go with the other options. And also, depending on where you are in life, that'll also depend whether you want weekly income or would you rather go with like a monthly vehicle. All right, I'm going to wrap it up. These are quick and dirty this week. I just wanted to get this out to you guys and wrap up the week, and we'll see how the war in Iran goes, and we'll see you in the next video. Hopefully that war gets done and we can get back to some sense of normality.